Yes. Mr. Rifat Sarcıklıoğlu, we will listen Mr. Rifat Sarcıklıoğlu, the president of TOP and B20 Turkey moderator, and Mr. Erdem Başçı, governor, Central Bank of Turkey, will be moderator of this panel, and Christine Lagarde, director, International Monetary Fund, IMF, Mr. Joe Hockey, treasurer, the Commonwealth of Australia, Christian Neuer, the governor, the Bank of France, Augustin Carstens, governor, Central Bank of Mexico, Dr. Rogaram Rayan, the governor, Reserve Bank of India. And the session 50B is about to start with the remarks of Mr. Rifat Sarcıklıoğlu, president of TOP and B20 Turkey chair. Basın mensubu arkadaşlar da fotoğrafları aldıktan sonra onları da yerlerine rica edeceğiz. Sayın Erdem Başçı da hazır gördüğüm kadarıyla, Sayın Moderatörümüz. Sayın Başkan, hazır mısınız? Sayın Başkan da hazır. Okey, teşekkürler.
Ben teşekkür ederim. Dear guests and colleagues, ladies and gentlemen, Madame Lagarde, Treasurer Hockey, dear governors, it is my honor to welcome you today. We are here to discuss the current global economic climate. The topic has become more important in recent weeks. Today, global stock and commodity exchange rocket up and down, and emerging market currencies continue to lose value. So, we must ask ourselves, how did we get here and what can be done? In the global economy, there is no simple answer. In fact, the global issues in general are too complex to give simple answers. However, there are a few items that I think we need to discuss in further detail. First, governments must support markets. They shouldn't be over-regulating. Interference in market signals panic the investors. It makes them lose trust in the system. With sensible regulations, we must let markets operate freely. As the business community, we need to navigate our ships, and for this we need the guidance of governments. Secondly, we must include the business community in the policy-making process. Currently, the private sector has no or little representation in international bodies, such as the Financial Stability Board, which are rewriting crucial regulations. Such lack of representations were seen to be dangerous in the past. For example, after the 2008 financial crisis, the regulations were written without the involvement of the business community. This led to the financial exclusion of SMEs. It has hugely damaged their ability to operate. Friends and colleagues, this is why the B20 is so important. Instead of operating in separate fields, the public and private sectors must work together. The B20 can ensure this. The B20 can bring business leaders, experts, and policy makers together. They can identify the world's most critical issues and offer innovative ideas and solutions. I believe the B20 is a great opportunity. We should use its full potential. Dear friends, it is our responsibility to push the global agenda forward. We should make the global economy work for everyone. We must work together to simplify and stabilize the global system. It should be open and accessible. Now I would like to turn to our panelists. They will discuss the state of the global economy and how the business community can navigate in these uncertain times. Thank you very much.
Is the microphone on? Yes. Yes. Okay. So we have a very distinguished panel with us, and we have roughly 1 hour for the panel. I will be very brief in my introductory remarks, and there will be one round of comments. We will focus on investments. Out of the 3 I's of the Turkish presidency, we will, in this panel, focus on investments. And the question will be quite simple. Compared to the pre-global financial crisis, investment to GDP ratios in almost all countries have been lower. This is happening despite extremely low interest rates and very accommodative monetary policies. Question is why? What is holding investments back? Suspects, number one, it could be the uncertainty and volatility and the associated volatility. Number two, it could be lower global growth prospects. And number three, it could be all the structural confidence-related factors like the business environment. So I would like to ask each and every one of our panelists to give us their views on this, not only the diagnosis, but also what can the B20, G20 community and also international institutions like the IMF can do about it to boost investments further. So I would like to start in this particular order from my left with Christine Lagarde, the Managing Director of the IMF. The floor is yours. Thank you. And roughly 10 minutes would be a good time for intervention. Thank you.
Well, thank you very much. I had a 45-minute speech prepared, which I will try to shrink into 10 minutes. You know, sometimes, particularly when you arrive in beautiful Ankara and you open the newspapers and you watch television and you listen to friends or look at social media, your whole sense of purpose is questioned. And the face to the sand of this little boy, Aylan, was really, certainly for me, a question to our humanity. And he's not alone. There are plenty of other ones. And I have to say that you have to sort of really go down into what you strongly believe in, what your mission is, what your organization mission is, to try to put the dots together. And I have to share one moment that, as head of the IMF, I had the privilege of having, and it was a 30-minute meeting with the Pope Francis. And we were talking about how the economy is critical for the world, what the role of finance was, and how it or not is helpful to spirituality, to hope, to the sense of purpose that each one of us has. And I was raising the issue of hope for the young people. And he said to me, he said, "Don't worry, we spiritual leaders, we can take care of hope, as long as you take care of jobs." And you know, it's in moments like that, or anecdotes like that, that I share with you, that you can sort of put the dots together. And I think that at the IMF, we can certainly draw some strength in our mission, which is to contribute to stability in the world. Because that stability is indeed needed for those who invest. There are all sorts of different kinds of investment. There is the public investment, which finds its limitation in the fiscal policy and the fiscal disciplines that states must observe. And then there is the massive private investment that is upon you and upon your decision-making processes. But I would bet you that if you were asked, you would say that stability, predictability, certainty are critical principles by which you will decide to invest or not invest. Now, I'd like to focus, and it's not that I want to avoid the question because I think it's perfectly relevant to the question that you asked. I'd like to focus on three things, which are responses to one particular matter which is common to all economies as we are looking at them at the moment. We have 188 members. One common factor is this fragile recovery, rather uneven, moving gradually from being primarily sourced in the emerging countries, less so at the moment, and worryingly so, more to the advanced economies, but not as fast as we would like. And that is the slow growth and this new mediocre environment that I have been talking about for a few months. And what is common to all economies, whether they are developing, emerging, or advanced? What we are seeing in that particular low growth is the lack of productivity, which would be the response in terms of quality of growth that we want to have. Thanks to the Australian G20 presidency, we have focused as G members on the quantity of growth. And Joe was instrumental in pushing all participants in identifying the actual precise measures that would be needed to ratchet up growth by at least 2% within 5 years. It's underway. It's not as efficient as it should be, but it's underway, and there is a target that has been set. I would like to speak to the quality, and in particular to the productivity component, and to give you specific examples in my short period of time. I would like to focus on infrastructure, which is one of the other I's, which is intimately related to investment. Because of all investments, investment in infrastructure is certainly one of those that has a medium to long-term effect, but also a short-term impact, and which can be certainly structured around the PPPs that your Prime Minister has indicated. Now, what we have found out in our research is that in the advanced economies, we found that 1 percentage point of GDP increase in investment spending would increase the level of output by about 0.4% in the same year. Not that much, but 1.5% after 4 years. As I said, if you combine the quantified effects of that infrastructure investment together with the combination of medium term, because it improves the factors of functioning of the economy, and the short-term impact, because you actually develop work, you have construction companies involved, and so on and so forth. It's a pretty strong eye, which is clearly embedded in investment. The second one that I want to mention briefly, and by the way, it's not any investment in infrastructure. It's efficient investment in infrastructure, where you actually try to cut the middleman, where you try to eliminate the sort of evaporation along the way, where you really make the procurement system as transparent as possible, and where efficiency actually drives the process. Massive difference between the inefficient investment in infrastructure and the efficient one. My second point is about the financial sector reform, and colleagues, central bankers will, I'm sure, talk about that. But I would like to take a couple of examples. One is the way in which, despite the quantitative easing, despite the monetary policies that are good to actually to activate the economy, some of the pipes are clogged, blocked, and the flow of credit took a long time to pick up and hasn't yet picked up to the point where it will facilitate investment. And that is largely attributable to these large chunks of non-performing loans that you find in some institutions. We certainly believe that in Europe in particular, there is still today a sizable amount of non-performing loans that should be dealt with, moved out of the sort of healthy circuits with a good management of bad banks and a good trading of bad loans or not performing loans, and with improvements to the insolvency regimes that apply in those countries that will facilitate and accelerate the treatment of insolvent companies, because that happens and is bound to happen, and that also encourages the out-of-court settlements. So those are two areas where it's clearly important to free up the circuits through which money can move around. Second, on that, on those financial sectors, clearly in developing country, a lot more work has to be done in order to structure the financial sector. The use by companies of financing through bank loans is 53% in advanced economies and is down to 34% in developing world. Is it to say that the developing world companies are less creditworthy? No. They all say that as one of the primary obstacles to investing, proper access to financing is the key because of its cost and because of the massive collateral requirements that there is. So another area where the financial sector structure has to also be addressed. My final point is on the labor and product market reforms. There are multiple examples where product market reforms by way of streamlining, simplifying, removing the obstacles, making it easier for enterprises, be they SMEs in particular or large companies, can actually encourage growth. We've got lots of good numbers, good studies done on this particular topic, but clearly a lot has to be done in cooperation between the B20 and the G20, between the business community and the policymakers. And in that particular sector, having been a finance minister, having been in the private sector for 20 years of my life, it's critical that leaders and business leaders be together, overlooking on the shoulder, over the shoulder of those who are supposed to implement those reforms, because they have no vested interests in doing so. And typically they will resurrect the obstacles and the constraints and the straitjacket in which companies eventually find themselves. Final and last point, which is very dear to my heart, the labor market reform. A lot needs to be done in many corners of the world. I was in Indonesia until yesterday, a country that has huge potential, a market which could thrive, and yet where the labor market is an obstacle because it's too rigid, because it's massively informal. So both in terms of fiscal policies, fiscal growth-friendly measures that will actually focus on facilitating work, jobs, access to the market, and in terms of regulatory environment in order to encourage inclusion, that's another eye of the Turkish presidency, so that women can also access the job market. In many corners of the world, more so than we think, there are obstacles, there's a bias, there's a massive gender gap between men access to the job market and women access to the job market. I was ever so pleased to see that Prime Minister Abe of Japan has decided to take that challenge to make sure that Japanese women could access the job market because they are talented, because they can contribute to the economy, and because at the moment there are too many obstacles for them. Many other leaders in the world can do that. It is the case in Turkey as well, which should be celebrated for its inclusion of the refugees of the world, as was indicated by Prime Minister, but which can do a lot more to include women on the job market. There has been some progress, limited, much more can be done. So on those three, investment in infrastructure, significant reform in the product and labor market, and improvement and fluidity with supervision of the financial sector, I believe that G20 and B20 leaders can together join hands and make sure that we provide responses to that job urge that is needed around the world to actually put a link between what is putting us to shame and what good we can do in the world. Thank you.
Thank you. Thank you very much, Christine. And we are looking forward to your support to the W20 initiative, yes, which is also forthcoming under the Turkish
presidency. Yes, indeed.
Turkish
that is on
presidency.
Sunday, W20 initiative. Very important.
Okay. Thank you. Our second panelist is Treasurer Joe Hockey from Australia. Under the Australian presidency, there has been a lot of efforts to boost investments and growth, And there has been this ambitious structural reform program, which was initiated in Brisbane, and now implementation will be the key. So the floor is yours, Honourable Treasurer Hockey, please.
Thank you, Erdem. Thank you, everyone. I feel rather honoured to be on this panel, especially with you, Christine. And to all of you, ladies and gentlemen, I apologise to the Australian media. I gave them a copy of my speech and now I'm tearing it up and doing something else. You asked me to speak about investment. And in talking about investment, I want to talk about three simple things. Number one, demand. Number two, supply. And number three, the rules of the game. The rules of the game. The world is awash in money. Thanks in part to all of my colleagues here who are either printing money or distributing money, but the world is awash in cash. And therefore, the world is also awash in investors, people that want to put money into investments. What does an investor want? You're all business people. You know what investors want. They want the highest return for the least risk. That's what investors want, the biggest return for the smallest risk. And they often say to government, you carry the risk and I'll invest. That's what they'll say. And of course, governments issue licences for broadcasting or gambling, for distribution of alcohol, or licences for banking, and basically it is a government saying, I'll take the risk, you put the money on the table. Those days are coming to an end. Those days are coming to an end because consumers are in control of the global economy now like never before. And they are in control because in their mobile phone they can get the information, they can get the access to money, they can set up a business, and they can engage in commerce with someone on the other side of the world without any intermediary. And if it's not happening now, it's definitely going to happen on a much larger scale in the next decade or so. So you get companies that are disintermediating, that have emerged from nowhere. Alibaba, Airbnb, Uber, Facebook, they're disintermediating the traditional mechanisms of commerce. And why? Because they are responding to the demand of consumers. Number one, demand. And what is the demand out there? The demand is for consumption. As the great middle class of Asia emerges, they want more goods, they want better quality healthcare, better quality education, better quality air, they want to travel more, they want all the things that are part and parcel of the middle class of developed nations. But also there is demand for infrastructure. In our region, in Asia alone, there is a shortfall of $8 trillion in infrastructure over the next decade, a shortfall. And the question is, how do you respond to that demand? And of course, here we are in the capital of Turkey. For 2,000 years, this has been part of the traditional Silk Road. 2,000 years ago, caravans used to go through the middle of this city, taking goods from the east to the west and back again. So the free flow of trade is something that actually the consumers demand. And Christine touched on women demanding the right to work. Of course, they should, as should everyone. The poorest people in the community demand the right to have a better quality of life, and we're seeing that tragically and graphically in the events of the last few days alone. Demand is there. There's no shortage of demand. Then it comes to supply. How do we respond? Well, the business community does respond with supply. Start-up businesses, more than ever before, using new technology in an innovative way. The role of government is to facilitate the supply meeting the demand. So government has to get out of the way. There's no shortage of supply. Iron ore. Australia, of course, even though iron ore prices have fallen, we still send enough iron ore to China each year to build the Golden Gate Bridge from San Francisco to New York back to San Francisco every year. Every year. And this year, with commodity prices falling, demand has increased to 600 million tonnes from 550 million. So there's no shortage of supply. Energy. There's a tremendous amount of energy. We can argue about whether you should have more renewable, whether you should have more uranium, but there's a huge amount of energy, and every day, somewhere in the world, we're discovering new sources of energy. And of course, supply of labour. There is no shortage of people that want to work in the world. No shortage at all. We try and set the rules of the game, but there is no shortage of labour. Innovation, we are at our most innovative. If you look at the per capita output of modern economies, China has achieved in just 10 years, China and India have achieved in just 10 years what it took 100 years for the British to achieve in the Industrial Revolution. So we're moving faster and faster with innovation. So you've got demand and you've got supply. Question is, how do we make it work? And that comes down to, as I said before, the rules of the game. The rules of the game. And the rules need to be consistent and predictable. That's the key. You cannot confuse the participants. So if we believe in free trade, it is not acceptable for countries to then impose new tariffs. We negotiate free trade with China, and then China imposes a 3% tariff on our coal. That confused our coal producers. Now we have to have a bilateral agreement, as the Chinese have agreed, to remove the tariffs they imposed on our coal. Indonesia, a country with massive potential, has just imposed a whole lot of new tariffs and protectionist initiatives, including on investment. Even Korea, Mexico, India, they're imposing in various parts new rules, new tariffs that run against the free trade that is so essential for building the economy. So we can complain about the fact that global trade has dropped in aggregate, but the biggest impediment to global trade is new protectionist measures by countries. We have to break down the trade barriers, and if we can't do it at a multilateral level, through the Doha rounds and TPP, we will do it at a bilateral level, and Australia is certainly doing that. Secondly, we need to have clear rules about taxation. It needs to be focused on rewarding innovation and investment, not penalising it. And the whole idea that because someone is successful, you should increase the taxation on them is a massive disincentive for investment and risk-taking and innovation. So you have to reduce the tax burden and provide incentive rather than penalising people and trying to reorder the movement of capital. Thirdly, you need to remove sovereign risk. Every country in the world is guilty of creating some level of sovereign risk, be it from a geopolitical perspective right through to even our own decisions which have unintended consequences. And we are guilty of that from time to time. So you need to reduce sovereign risk because in turn, all it does is make it more difficult for global capital, which will go anywhere to get the right rate of return on investment. It makes it more difficult for that global capital to be able to price the investment. And finally, in relation to infrastructure, governments have a clear role in helping to facilitate infrastructure, but we've also got a clear role in making sure that we have as consistent a rule and paradigm as possible. Last year in the G20, we set up the G20 agreed to set up the Global Infrastructure Hub. The Global Infrastructure Hub, even though it's based in Sydney, is a global platform to develop consistent rules, world's best benchmarks, and also importantly, to spread information right across the world so that if you're building a water treatment plant in Turkey and a water treatment plant in Vietnam, you know that you have essentially consistent rules, consistent documentation, consistent information in order to judge the investment and return. And that Global Infrastructure Hub has significant financial commitments from 8 countries in the G20, and a number of other countries are making additional commitments as well. Finally, can I say this? I actually believe, I emphatically believe, that the world is going to be better next year than it is this year, that the economy is going to be better next year than this year. But you cannot let the pessimists win in this battle. There's plenty of money out there, there's plenty of investment opportunity, but we have to believe in our own inherent ability to make things happen. And it's got to be a partnership between the business community and governments. The business community cannot be a silent cheer squad. It must be an activist. It must be out there working to convince your shareholders and our voters that in fact reform has no finishing line, that in fact change is good when it is mainly controlled by consumers and when governments help to facilitate that change. And most importantly of all, if we allow in the misinformation associated with a range of different economic data to become pervasive, then we'll pay a significant price. And I say in particular in relation to China. As a country whose biggest investor, foreign investor on a yearly basis now is China, whose biggest strategic trading partner is China, and of a population of 24 million, we have 1 million speaking an Asian language at night at home, and as someone who is in the geopolitical region with China, the amount of misinformation about China, particularly in relation to its stock market, has in many ways scared serious investors. And we all have an obligation through the G20 and other forums to spread the truth about what is really happening in our economies and how we can in fact help to build a more prosperous world. Thank you.
Thank you. Thank you very much, Treasurer Hockey. Now, among our neighbors, the best performing region is European Union right now. So there is a recovery, although not as strong as we would wish. We look forward to the continuation of the recovery in Europe. Yep. And now I give the floor to Governor Christian Neuer to hear his views about the recovery and investments prospects in France, in EU, and globally. The floor is yours.
Thank you. Thank you very much, thank you very much. Much has been said already, so I intend to be relatively short. It's true that a striking factor behind the low growth environment is the low level of investment. Just to give one figure, I think in aggregate, in advanced economies, the rate of investment is 3 percentage points of GDP below its pre-crisis level. So we have something there. It has been described. There's been a lot of literature on that. I would say either as a savings glut or in an investment strike, depending on whether you think there is too little investment or too much savings. The difference between being consumption, of course. And when you look at that from the investment side, what are the reasons why there is so little investment compared to before? All the studies, there are excellent studies by the International Monetary Fund, but we've done some research in central banks also on that, on our precise region. We've done that in Banque de France, for instance. And the conclusion is always the same. It's not primarily the cost of capital, so almost negligible, the cost of capital, probably thanks to the action of central banks, by the way. But it's mostly, it may be sometimes, but not in advanced economies, the availability of capital. But it's mostly the role of demand and the role of uncertainty. It's very important to understand, this was mentioned already before me, but of course, the role of demand is crucial. As a business leader, you will invest if you believe that there will be more demand for your products, or you see there is more demand for our products, or you see that the market will be demanding products or are asking for products that you need to develop. And if the demand is sluggish, you will not invest much. But the role of uncertainty is absolutely critical. If you are in an environment when it's too difficult to predict for future developments, and the risk of turning around of economic developments is too high, then there is a big decline in investment. We've seen that in stressed economies in Europe during the second episode of the crisis that we had during the last few years. Now, hopefully, is totally behind us. If you take that from the point of view of the savings, why is there so much saving in view of the demand for investment? I think there are two quite important developments that we have to understand. One is the aging of the population. It's not a global phenomenon, thanks to a number of emerging markets where the tendency is still to have a high growth of population and young population. But it's not only the advanced economies. If we think of China, for instance, it's not that different from some of the countries in Europe or Japan or even the US, where we see that the development. So the tendency to have high saving rates is important because of this factor. But there is another factor, of course, much more temporary, hopefully, which is the deleveraging that is following the Great Recession. Deleveraging for households in some countries. I'm thinking of the US, the UK, Spain, but there are other similar countries where the rate of indebtedness of households has been too high. In some way, one could say part of the past growth, pre-crisis growth, was artificial with too high indebtedness, which could not continue indefinitely. There is also, in a number of countries, too high public debt, which means that fiscal policies have to be geared towards reducing the ratios of debt to GDP. There has been also the question of too high leverage of the banking sector. This is being fixed by the new regulations. By the way, it's extremely delicate to strike the right balance between the necessary consolidation of balance sheets of the financial sector to give strength to this sector and avoid the risk of a new financial crisis. We know now the enormous costs of such a crisis. On the other hand, if we go too far and we are too risk adverse, the risk is of a strong deleveraging. It's not enough to say banks just need to raise capital, because if there is no prospect of good return on investment, they would choose to deleverage rather than to increase their capital base. And also, if we ask them to do that too quickly, difficulty of raising too much capital will mean also that they will deleverage. So we have to be cautious and strike the right balance at each moment, which means that it's not an easy task for the G20. Now, what can we do beyond that? I will say little of monetary policy. Everybody knows what we have been doing, and this time not only in reducing short-term interest rates to unprecedented levels around zero in all the major economies, but also by acting on the, or triggering a flattening of the yield curve. That is, we have done a lot for the medium to long-term cost of capital. And as a matter of fact, we've not only had results on the cost of lending, on the cost of issuing bonds, but also on the cost of issuing equity because of the impact we've had on stock prices. But monetary policy cannot alone sustain activity and solve the problems. It's been said from time to time that we, at times, seem to be the only game in town. There's certainly a position that we do not want the central bankers to keep or to occupy. The other channels to boost investment and growth have to be used, and those are related to other public policies. If we look at the demand side, the question of investment has been investment in infrastructure, for instance, been mentioned by Joe Hockey, very rightly so. I think investment in infrastructure is not only acting on the demand side, but has also a big advantage in terms of supply, in enhancing the capacity, the growth potential, the capacity of the economy to grow. But public fiscal policies can also act in terms of facilitating private investment. The structure of the budgets is extremely important. The tax policies, whether they are geared to facilitate or encourage investment or not, are extremely important. It's true that in many countries today there is little fiscal space, but acting on the structure of expenditure or the structure of receipts, of income for the states is a very important tool. Of course, it means that some savings have to be made on current expenditure, which we know is not always easy, but is absolutely necessary in many cases. But there are also many other policies that can be used or should be used, what I would call the pro-competitive policy reforms, and that has been mentioned already, labor market reforms, goods and services reforms, all what can increase the opportunities to invest, to grow for businesses, all the tools that permit to increase the return on capital will accelerate investment and growth. Two last remarks. One is on certainty. I think Joe Hockey mentioned very rightly that a key factor for decision of investments is the clarity of the future in terms of taxation and in terms of regulation. If there are constant changes of policies, then the level of uncertainty is so high that it will impede investment enormously. And another factor that was mentioned by Christine Lagarde is absolutely key. It is the fact that if we look at the composition of investment during the last few years in business investment, it has been focused much too much on operating efficiency and I could say tax strategy, and relatively little, and certainly not enough, on R&D and innovation. And that's, of course, the only items with which we will build long-term growth. So I think this aspect is absolutely key. It needs to be taken into account in the public strategies. I think it needs also to be taken into account by business responsibles. What are the ways that your business can grow in the future that's based on R&D and innovation, and certainly not only on consolidation, which may bring an increase in short-term profits, but not build a bright future. Thank you very much.
Thank you very much indeed, Governor Neuer. Now, our fourth panelist will be Governor Agustin Cartens of Mexico. Mexico is very similar to Turkey, because as much as Turkey would benefit from European recovery, Mexico would benefit from the United States recovery, and we are basically selling more or less the same goods to these countries, durables mostly. So I would like to hear your views, and Governor Cartens is also right now the chairman of the IMFC. So the floor is yours, please.
Thank you very much, Erdem, and it's a pleasure to be here again in another fora, in another event of the B20. I would like to start by reminding all of us how the dimension of the G20 that we have today originated. And we have to go back to 2008. Certainly the Prime Minister pointed out that the financial crisis, global financial crisis of 2008 and 2009 was one of the key benchmarks in the recent history of humanity. And I think we shouldn't forget that this crisis was huge. It started in the financial sector. Now we have to also remind ourselves what the financial sector means. The financial sector is a key component in every economic system to channel savings to investment. And that precise channel, that element that captures savings and channels resources to investment was massively damaged during that crisis. And therefore, we had to invest huge amounts of attention to the resolution of that problem. At the same time, huge amounts of wealth were destroyed. And as a matter of fact, many problems haven't been completely resolved. As Christine said, there are still very legacy assets still unresolved there. But we have to keep in mind that that was a major issue, and I think we have made a lot of progress in bringing back the resilience and the capacity of the financial system to intermediate resources. And as a matter of fact, now that we're going through a difficult period in time in the world economy, it's a plus that we have gone through those reforms, and I think this will help us further. This obviously talks also to the issue of confidence and trust and certainty that is key for investment. The global financial crisis was not only in the financial sector. Of course, it generated a huge fall in output growth. At the beginning, I would say, we had probably too much trust in short-term macro policy management to defeat the business cycle. We have been depending a lot on fiscal and monetary policies, and that has given us a little bit of traction. But I think that we have pretty much depleting all the capacity of those instruments to generate more growth and induce more investment. As a witness of that is precisely the fact that we are awash in liquidity, very low interest rates, and investment is not coming. So as a matter of fact, as Christian mentioned, it's not appropriate to have central banks as the only game in town. It's important that at some point that goes back to normal. Fiscal policy has pretty much run its course, and therefore now we have to focus on the factors that really generate growth and that, as a matter of fact, really are the main, I would say, the triggers of more investment. And this is precisely the structural reforms. I think it was a major plus that that Australia, under Joe Hockey's leadership, forced us in last year's G20 to concentrate on structural reforms. Structural reforms are the hard way to induce growth. I mean, there is no simple structural reforms. In some cases, the benefits are quick because there are low-lying apples that can be reaped, but many of them take time to induce more growth. And I think the fact that oftentimes we don't think in structural reforms is precisely because they're hard to do. And we depend on short-term macro policies to sort of deal with the cycle, and we tend to forget on potential growth. Now, in that sense, crises are good because they remind us that important things need to be taken care of at the appropriate time, and I think that we are precisely in those moments. And these are moments that really will define the future of economic performance in the years to come. It really is surprising when you sit down in your own country or a region and even in the world to see how many opportunities for more growth there is. I mean, certainly in Mexico we have entered into a massive campaign towards structural reforms. Just to give you a very obvious one, it is, I think, very clear for all of you that energy is of the essence. In Mexico, the electricity and the oil sector, being in Mexico a very rich oil country, I mean, with plenty of resources, we kept 70 years the oil and the electricity sector under the budget constraint of the government and under the administrative capacity of the government. Both of those two constraints are tremendously disadvantageous. Therefore, President Peña Nieto decided to liberate those two sectors. So now, electricity and oil are sectors that were close to private investment and now are open to private investment. And obviously, we think that that will increase dramatically productivity and the potential for growth in Mexico. Antitrust is another issue. Antitrust basically is to keep monopolies. It's like having taxation with the difference that the one who collects the income is private investors or a few private investors with the cost to society, to efficiency, and so on. Also, if you have inadequate antitrust legislation, you can open sectors to investment, and that also will enhance productivity. That is a very important reform that we also are undertaking in Mexico. Joe talked to openness, to free trade. We fully subscribe to that. Labor reform, as Christine said, is of the essence. I think labor reform has also been connected with another very important process of investment, and that is investment in human capital, and that's education. Mostly because, well, especially in countries with youth, and at the same time, not only having plentiful supply of young people, but also we have to be mindful of the fact that innovation and IT, even though in some sectors there might not be enough investment, as Christian said, but I think one of the realities of this decade and the decades to come is that innovation and technical change will make our economies more efficient, but they also have the threat of destroying massive amounts of routine jobs. And the issue is, how are we going to provide employment for those people who will be displaced by technology? And therefore, I think we shouldn't forget the need to invest in education and to make labor market flexible and to embrace technology in such a way that it makes our economy more efficient, but also provides opportunity for personal development. I have to say the other point that is of the essence is the rule of law, not only internationally, but also locally and regionally. That is of the essence, not only for local investments, but also for international investments. So there is a broad agenda. I think there is a lot of issues in which both the authorities and the business sectors can work together. One important area is, for example, just in terms of gearing education, or having enough information and interaction between the business sector and education authorities, ministries of education, in terms of what are the skills that business will need in the future. I mean, there are so many examples in which some sectors cannot develop in some countries just because there is not the adequate labor supply. So I would say further communication there is of the essence. And I also believe that in terms of the financial sector being in a position to support growth, I think that we are there now. I mean, I think that the most important part of the financial sector reform has been done. I think that we should work further to provide more macro stability and certainty, and the financial sector should be ready to engage and support investment opportunities as infrastructure, as precisely Joe said. So I have faith, I have hope, and I also have hope for jobs. So thank you very much.
Thank you very much, Governor Carstens. Now, our final panelist is Governor Raghuram Rajan. India also is a country with an ambitious structural reform program and has great potential for growth. The floor is yours.
Thank you very much, and it's a great pleasure to be here in Ankara. I have to say we are in a deeply puzzling situation in the global economy. We live in an age of many possibilities. We have millions across the world, many in Asia, many in Africa coming out of poverty. We have many new technologies. We have fantastic new solutions to old health problems. We have new ways of communicating. We have new ways of building community. And despite all this, despite this prospect of plenty, we are surrounded by economic gloom. Every few months, the forecasts from the IMF get gloomier and gloomier. So what is really going on? And we've heard many descriptions of the problem and many good solutions. I want to focus on one particular one, which is the role of us central bankers. But let me come to that. In the wake of the crisis, there was an important feeling that stimulus, initially fiscal but complemented by monetary stimulus, would be a bridge to strong, sustainable growth. And as countries reached the limits of fiscal policy, it became the role of monetary policy, as Christian and Augustine have said, it became the only game in town. And unlike fiscal policy, it was thought to be costless because inflation was nowhere on the horizon. In fact, there were dangers of deflation. And across the industrial world, as well as some parts of the emerging markets, we have pressed on the monetary accelerator in an attempt to return the economy to pre-crisis growth. But one must remember that finance, especially as motivated by central banks, is really only a lubricant to growth. It's a handmaiden. It can't be the underlying engine of growth. And if it purports to be the underlying engine, you create enormous distortions in the process. The truth is, real change has not happened fast enough, hasn't happened in the right places, and we need to understand why. Let me step back a second to the basic premise of the panel. We live in an environment where desired savings exceed the investment that is coming up. So in ordinary economic theory, it would say the interest rate that should prevail in the markets should be really low. And central banks have been trying to nudge market interest rates towards this very low neutral rate, which will balance savings and investment. Now, if you look at a report card of the central bank performance, then the way to analyze it is to look at investment in the industrial world. Has it picked up? And have savings come down? Because that was what they were trying to do. What you see is in the industrial world, investment has actually come down post-crisis by about 1.5 percentage points of GDP. Savings haven't budged. So this is a twin puzzle. Why haven't savings come down despite tremendous attempts to get savings down? And why hasn't investment picked up despite tremendous attempts to get investment up? Of course, the flip side of it is emerging markets increased investment, largely driven by China. Again, with emerging markets, savings was relatively constant. So I want to focus on 4 possibilities and just outline them. One was that the pre-financial crisis model was unsustainable. 2, the financial crisis itself had effects on savings and investment, some of which has been talked about by Christian and Augustine. 3, since the financial crisis, other factors have become salient, perhaps as a result of the financial crisis. And the 4th is maybe central banks have a part to play in the low savings, in the low investment phenomenon post-crisis. So let me just emphasize or detail each of these points. 1, pre-financial crisis, the models were unsustainable. I think that is something we have to come to accept. The demand that was created in industrial countries, a significant portion was debt-driven demand. And the export-led growth of the emerging markets was an attempt to service this debt-driven demand. So as the debt-driven demand fell off post-financial crisis because of the deleveraging that Christian talked about, the export-led growth strategy was no longer as sustainable. Increasingly, all of us have to focus on creating sustainable domestic demand, and that is proving more difficult than we thought. Second potential was the financial crisis itself created problems, and that's clear. A number of households were over-leveraged. They had to deleverage. A number of corporations were over-leveraged. Banks were over-leveraged. All of them have had to deleverage. But there's another phenomenon also going on, which is that with asset prices having crashed post-crisis, and with many people becoming more aware of the need to rebuild savings given aging populations, perhaps also there has been a greater incentive to save as a result of the financial crisis. Now, clearly, a number of factors have also become important post-crisis. Governments in the industrial world, having become more indebted, can't deliver on the promises that they had made on social security, on healthcare. Therefore, more and more people are saving for that, again, increasing savings. And also, we have seen post-financial crisis a re-emphasis on the low productivity which prevailed before the financial crisis. Given low productivity growth, given rapid technological obsolescence, the fears of businesses in investing also come to the front. So there are all these possibilities. But I want to emphasize one last, not because it's the only problem, there are many others which have been pointed by people in the panel, but because I think it is becoming more salient today. And that is, what are the effects of extremely aggressive monetary policy across the world in contributing to the low investment? Now, again, monetary policy can be good if it contributes to sustainable growth. But if the primary effect is through financial markets, through distorting asset prices and distorting real asset allocations, the private sector knows it has to be corrected at some point. that a boom in bond prices will eventually reverse. And given that prospect of volatility, there will be a fear of investment, both on the part of the private sector as well as on the part of savers who worry about asset price adjustments. One example of a saver who's putting its money in the safest place because it fears doing anything else is corporations around the world. You look at cash holdings by corporations around the world, increased substantially over the last few years, primarily because of the fear of investing in real assets or investing in longer-term financial assets. Moreover, the argument in industrial countries was reduce interest rates, we would reduce savings, increase investment. Well, savings didn't fall, investment fell, so money flowed out. Capital flowed out of the industrial countries, went to emerging markets, created an investment boom there, and now that capital is flowing back, created fragilities in the rest of the world. So it's not just that we haven't done any good, at least in the near term, but perhaps there has been increased fragilities created because of over-leveraging in the industrial countries and perhaps excess capital flowing to emerging markets, which is now coming out. Now, the typical pattern in emerging markets was capital flowed in, exchange rates appreciated, industries became less competitive, growth slowed, capital started flowing out. That pattern is reasserting itself again. So the worry now is across the world, have we reached the limits of monetary policy? In fact, crossed the barrier from monetary policy doing good to monetary policy creating competitive devaluations and doing more bad than good. We're all competing for the same low pool of growth rather than generating growth ourselves. So let me end by saying, what do we do now? Let me start with the monetary policy angle and then go to the rest of the economy. We live in a world with potentially because I don't know for sure, but potentially distorted asset prices and exchange rates. In this world, there's a fear that monetary policy normalization will result in a significant volatility in terms of asset prices and exchange rates, which will depress activity more. So there's a temptation to continue with the status quo. The problem, of course, is if we don't deal with this problem now, we'll have to deal with it in the future. And that future volatility itself could serve as an overhang to activity as people worry about putting their money here or there because of changes in exchange rates and changes in asset prices. So we risk, as central banks, being trapped in a prisoner's dilemma. Nobody wants to be the first to leave this extremely accommodative situation. We prolong a period of extreme monetary accommodation, but build up the volatility that eventually has to emerge. So we really need to rethink this. If this is really what's going on, should we attempt opportunistically to return to normalcy? I'm not saying at one go in one big bank, interest rates across the world increase. I mean that economies that seem to be reaching takeoff stage should use the opportunity when volatility is relatively low to actually start moving back to normalcy. Yes, that will create volatility, but that will also remove the overhang of volatility that could perhaps be suppressing activity across the world. We should not be scared of volatility. We've built it up. Perhaps we should not have done that. But, bygones are bygones. We are where we are. We need to move forward. It is time to plan exits from the extremely accommodative monetary policies that we have. And the longer we persist with this, more the real economic costs, but more also the political costs as we favor borrowers versus savers, and monetary policies come into question by political establishments across the world. Now, removing monetary accommodation is not a solution to the overall growth problem. It is just part of the solution. The real solution lies in the real side activities that have been proposed, absolutely. And I would say that there is no better mantra than what the Turkish presidency has proposed, which is implementation of past reforms, of prospective reforms, investment. We absolutely need more investment, perhaps the public sector has to show the way in providing for the investment, but the private sector can carry it out. And third, we need to bring more people into the economy, into the formal economy across the world and within economies itself through the process of inclusion. So implementation, investment, inclusion, I think those are very good guideposts, but let us rely less on monetary policy. Thank you.
Okay. Thank you. Thank you very much, Governor Rajan. This dialogue will continue. During dinner, we will have a brainstorming session. We have seen all the recommendations, 19 recommendations of the B20, and we have actually discussed 3 of them during this panel, but we will continue discussing the remaining recommendations. So I would like to thank all the panelists, and please join me to thank all of them.
Thank you very much for all the panelists again, and ladies and gentlemen, Sayın Başçı çok teşekkür ediyoruz, and all the panelists. Ladies and gentlemen, now we would like to invite you for lunch in downstairs, and we will come back to the halls from 2:50 p.m. 2:50. We had planned to start at 2 o'clock, but we had a little delay. That's why we will start our meetings from 2:50 p.m. 2:50. 2:30. 2:30. Correction, 2:30.
Afternoon sessions will start
Yeah.
at 2:30.
Afternoon session will start at 2:30. Thank you very much.